Hey everybody, Josh Bennett here with College Funding Hero. Planning for college can be a really daunting process, especially to start determining what type of account you should be even saving for college in the first place. There's a lot of different options out there, and each option has different taxability, different investment options. It can be a really confusing and daunting process trying to figure out what's the best route for you and your family. Well, in this video, we're going to talk about some of the main account types for saving for college. And we're going to take a look at some of the pros and cons of each of those types of accounts. So hopefully you can narrow down what are some of the best options for your family. Well, let's take a look. When thinking through the type of accounts that you want to use for funding college or saving for college, there's a couple of different criteria that you need to consider. One of the main ones is what's the tax benefits of this account. So there's a lot of different account types out there that give you a lot of tax incentives to save for college. So that can be really beneficial when you're trying to save for college because any money that you're not paying for taxes can just go right back to actually affording that college. Another thing to consider is what are the investment options. So there's a full range of what investment options are available. Some will be more flexible in what they offer, and some will be very limited in what they offer. The other is operational flexibility. Some are very limited in terms of what you can do with those accounts, where they can be, where those funds can go, who can use those funds, etc. So considering what the operational flexibility is going to be a crucial component, as well as what are the financial aid impacts. So any savings that you have, whether for college or for just your general net worth, those can be used against you in terms of calculating your financial aid. And each account type has a different impact in terms of your ability to later on get financial aid. So we're going to look at the different types and how these different account types are impacted through that lens. One of the most popular accounts for saving for college is popular for some good reasons because it gives you a lot of tax benefits to save for college. So it really incentivizes you to start saving and get some benefits for saving for college. And that's the 529 plan. So the 529 plan has a couple really cool tax incentives. So one of the biggest ones is that it actually grows tax-free. So for example, any money that you have invested in that 529 from year to year, you're not getting taxed on any of the income that those investments produce or any of the growth that those investments produce. And as long as that money is used for qualified education expenses, such as like college tuition, then any of the withdrawals from that 529 are going to be tax-free. And to be like have an even bigger cherry on top is a lot of states even give you a tax deduction for putting that money into the 529 in the first place. So you get a tax benefit on the inside, you get a tax benefit on the growth, and you get a tax benefit when you take it out. So it's pretty obvious why it's a pretty popular account. And other nice aspects of the 529 plan is it has a pretty high contribution limit. So the contribution limits run around gift tax regulations. So what that means is basically each individual, for example, like an individual like myself, I'm able to gift up to $15,000 per year to another individual without any taxes or gift tax or estate tax issues coming into play. So for example, a parent can contribute $15,000 to a child into their 529 with no tax implications. And if you have two parents doing it, you can do $30,000 a year into that 529 plan. And an even added benefit to that 529 plan, especially if you have a young child, you can contribute up to 5 years of gift tax rules all at once. So between two parents, you could get $150,000 into that 529 plan and then just let it grow from there. So a really powerful tool. However, it does have some limitations. One of the limitations are that 529s are usually state-sponsored plans. So with that, you have sort of limited investment options. So it sort of works like a 401k or a pension plan where basically the state says, all right, you open this 529, here's your investment options. You can choose conservative, moderate, aggressive, or somewhere in between. So you don't really have the flexibility to choose specific investments. So you can basically choose from a predetermined set of just portfolio allocations. Another limitation is that those funds have to be used for education expenses. They recently changed it so you can use it for K through 12 education expenses as long as it's going towards education, but it used to be only higher education, but either way, it still has to go to qualified education expenses such as tuition. If it's not used for higher education, you could get a 10% penalty as well as taxed on that money when it comes out. So it's not ideal to use it for anything other than education. And where that can bump into problems is, say you have a situation where you fund a 529 for a young child, and when you don't know what type of student they're going to be, what their hopes and dreams are going to be, and then next thing you know, they either have a full ride and they don't need that 529 money, or they decide to go to the military or get a full ride athletic scholarship, or whatever the case may be, you could get in a situation where you're stuck with money in a 529. That being said, they do give you the option to gift that 529 or transfer it to another family member. So if they have a sibling, you can move that money to another sibling. It can be used, for their kids or their own higher education, so even past college, such as master's degree, PhDs, things like that. So you do have some options, but there are some limitations in terms of transferability and who can use that money and where those funds can be used. So just something to keep in the back of your mind. Another really popular account type that has a lot of the tax incentives in it is what's called the Coverdale ESA. So it stands for Coverdale Education Savings Account. So this is an account that, like the 529, has the tax incentives. So for example, any of the money you put in there gets tax-free growth, and as long as it's used for qualified education expenses on the outset or when you withdraw, that's tax-free growth. However, some of the limitations with the Coverdale is that there's only a $2,000 contribution limit each year. So you can only contribute $2,000 to the account each year. However, any of that money that's invested in there can be invested in anything. So there's a lot of investment flexibility when it comes to Coverdale ESA. And the reason for that is, unlike a 529 where the accounts are basically state sponsored and work kind of like a 401k, a Coverdale basically, usually you open those at, say, a brokerage institution like Schwab, Fidelity, Vanguard, etc., where you can invest in pretty much anything that's out there available in the market: stocks, bonds, ETFs, mutual funds. So you have a lot of investment flexibility when it comes to a Coverdale ESA. Like the 529 as well, you can use the Coverdale ESA for anything K through 12, higher education, such as college, masters, etc. One of the limitations, though, that Coverdale has that the 529 doesn't, is that any money in the Coverdale has to be taken out of that account before the child reaches the age of 30. So 529, you can basically just leave in there, let it sit, and keep it invested. Coverdale has to be out by the age of 30. So that's one of the big differentiators between the two accounts, other than the contribution limits. Another account that you can use is what's called a universal transfer to minors, universal gift to minors, or UGMA accounts, but more commonly they're known as just custodial accounts. So basically it's just an account where you have the minor as their names on the account, and then you have the parents who are actually the custodian on the account. So the parents really get to make all the decisions in terms of investments until the child reaches either 18, 21, or 25, depending on the state. So any money that's put into a custodial account such as these is an irrevocable gift to the minor. So where that's important to understand is because when you're thinking of financial aid and getting financial aid, there's a big difference in terms of how child's assets versus parents' assets are looked at in financial aid. So 529s and custodial accounts, 529s and Coverdales are looked at as parent assets. So they're really good for financial aid. Whereas a custodial account is looked at as child assets, which is not good for financial aid. However, with the custodial account, like the Coverdale, you have unlimited investment options. So you can open that at any regular institution such as Schwab, Fidelity, and you can invest in really whatever you want. So you can buy stocks, bonds, mutual funds. So you have a lot of investment flexibility, and there's no contribution limit. So you can sock away a lot for savings into that custodial account. Downside is it's not very tax efficient. So there's not really tax incentives. All you can really do is some of the money in that custodial account will get taxed at the child's rate, which is going to be slightly lower than the parents. But there are different thresholds that seem to be kind of ever changing. But for the most part, you can only basically, and those are all lumped within the kiddie tax rules. But for the most part, the majority of the account is going to be taxed either at the child's income level or the parent's income level. And so therefore you don't get the tax incentives on either end really that like you do with the 529 or the Coverdale ESA. With that tax incentive, you just get basically $2,200 that's of unearned income that's at that that kid's level. So again, really not a powerful tool when it comes to tax savings. One of the big benefits though from the tax side, even though it's not very efficient from the actual tax incentives, unlike the 529 or the Coverdale, when you take money out for things other than college education, you don't get any tax penalties. So for example, you can take that out and that custodial account could be used for a kid's future down payment or weddings or whatever. So you get a lot of more flexibility in terms of what that money can be used for. So for example, if you get in a situation where you have a bunch of college savings, your kid gets a full ride and you want to reward them with a new car or whatever the case may be, or use that for a future down payment when they get out of college, you have that option with a custodial account where you don't have that with a 529 or an ESA. Another account is just a taxable brokerage account. So a taxable brokerage account is just works like any other savings account or investment account, just saving for a house, just general wealth accumulation, whatever the case may be. But you have sort of the most flexibility when it comes to these types of accounts. So a taxable brokerage account, there's no contribution limits. You can invest in anything you want in the universe. So you just open that again at a place like Schwab, Fidelity, TD Ameritrade, you name it. And you can invest in stocks, bonds, mutual funds. So you can invest in whatever options you can think of, really. And so it gives you the most flexibility from the investment types, what you can use it for. And the one trick with the brokerage account is who owns that brokerage account can have a tremendous impact on financial aid. So if that brokerage account is in the parent's name, then those assets are calculated as parent assets for financial aid, which again are better for your possibilities of getting financial aid. If the child is the owner of the brokerage account, then that's going to count as child assets. If there's a joint between parents and the child, it's going to look at it's 50% the child and 50% the parents. So you'll kind of be split when it comes to financial aid. So as long as the account is in the parent's name, you're not going to be impacted from the financial aid calculations, and you'll have a lot of flexibility. The one thing you lose out on, though, is tax efficiency, because there's really no tax incentives for a taxable brokerage account. It's just like any other investment account. You just have capital gains rates and income tax rates. The last account type is kind of counterintuitive because it's actually an individual retirement account or a Roth IRA. So, or a Roth individual retirement account. So even though it says retirement account in the name, the nice thing is that there are tax incentive accounts. So for example, like a traditional IRA, any of the money they put in there grows tax-free, and then you only pay taxes when you withdraw those funds. Same with a Roth IRA, just the reverse. So any money you put into a Roth IRA, you put in after tax, grows tax-free, and then you never pay taxes on it again. Well, typically, if you use money in an IRA for anything before the age of 59 and a half, since it's designed to be a retirement account, you would typically get a 10% penalty, plus you'd be taxed on that. However, the IRS allows you to take withdrawals from a retirement account in order to fund college. So this is another good tool that can be used to pay for college. You get the tax incentives. With an IRA, you can invest in anything you want. So it works similar to a taxable brokerage account, just with the tax incentives associated with it because of the retirement aspect. So you get the full flexibility. Downside is that it's obviously a retirement account. So any money that you withdraw from your retirement account, you're limited on the contributions that you put in from year to year. So you're only able to put in $6,000 into a Roth or traditional or some combination of the two. So you get $6,000 total that you can put into a individual retirement account. That's all you're allowed per year. So if you take out a ton, you may be crippling your chances for having a successful retirement later on. So you want to be kind of careful using your retirement funds to pay for college, but if you need the options, that is one that can be used. So it's a great kind of tool for last resort, in my opinion. I wouldn't necessarily use these as a primary source for college funding, but it is a good last resort that gives you a lot of tax incentives. There's some decent operational efficiency there because you can sort of use it however you want as long as it's used for college expenses or withdrawing for college expenses, and you have the investment flexibility there as well. So these are the main type of accounts that you can use for retirement. So hopefully the pros and cons here gave you some ideas on how you can use these for college. And you don't have to pick just one. That's one of the most important factors, is that you don't have to pick just one account. You can use some sort of mixture. So for example, say you want the tax incentives, but you want a little flexibility in case, because you have young kids and you're not sure what kind of students they're going to be. Well, you could save 50% of your money into a 529 plan and 50% of your money into a taxable brokerage account in the parents' names. So then you can do a little bit of both. So you can sort of hedge your bets. There's no limitation on how much you can do or how you kind of move these different shells around outside of the contribution limits. You can ultimately use all of these as tools for paying for college, and a lot of people do. But it's really thinking through what is going to be the best tools for you and your family. Hopefully you found this video useful. If you did, give that thumbs up, a like, and if you have any questions, make sure you leave us a comment below and ask any questions. We peruse those comments to see if we can answer anything that's out there. But yeah, again, hope you found this valuable. Until next time, cheers.